Morning, everyone, and welcome to Why Spreads and the Benefits Made Easy. My name is Gail Mercer. I'm the founder of TradersHelpDesk, and I'm going to be your hostess for this morning. Now, before we get started, I would like everyone to read over the Nadex risk disclaimer. This is for your protection as well as ours. And basically, the bottom line is you should not trade with money you cannot afford to lose. Any type of investment will carry risk, including binary options and spreads. Now, for those of you that do not know me, my name is Gail Mercer. I did found Traders Help Desk. I have more than 15 years of experience. I started out with a company that programmed indicators and just absolutely fell in love with the price bar. I specialize in price action, volume analysis, divergence, because I believe they are leading indicators. I'm also a frequent contributor for Stocks and Commodities magazine, Traders World, and Top Shelf. I have previously been a speaker at Traders Expo, Traders World Online Expo, and the Wyckoff Volume Conference. I'm also the author of Trading Nadex Binary Options Using Currencies, Trading Nadex Binary Options, Keeping It Simple Strategies, as well as the New Trader's Guide to Trading Nadex Binary Options in Spreads. These books can be purchased on my website or through Amazon. Now, before we get into spreads, I really want to go through the anatomy of a binary option. You need to understand all of the components so that you will understand how spreads are different from binaries. Now, the binary option consists of the contract and the strike price, followed by the expiration. And then you have a bid price and an offer price. The bid is used to sell the instrument. The offer is used to buy the instrument. Now, the maximum payout on any binary option is equal to $100. Now, if you were to purchase this binary contract on the euro dollar greater than 1.1774 by 7 a.m. and price expires at 1774.1, then your profit is realized. Now, the risk in this example, would be $54.25. Now, you see that right under the offer column, So the profit realized, again, if at expiration the price is greater than 1774, then your profit would be $45.75, excluding your exchange fees. Now, remember, the maximum payout is $100, but then you subtract your risk, which was $54.25, giving you that $45.75 profit. However, if at 7 a.m. the price is equal to 1.1774 or less, then you lose what you paid on entry. So this is considered your risk. At no time could you lose more than what you have paid on entry. Now, let's go through the anatomy of a spread, and you'll see some similarities here, but then you're going to learn how they are different. First, you have your contract, which in this case is the euro US dollar. Then you have your expiration over here at the end. So this tells me it expires at 7 a.m. Now, you also have a floor price, and that is listed on the left-hand side. And this is considered the floor. Over on the right-hand side, you have the ceiling, okay? So this is your ceiling, and this is your floor, okay? Now, you also have a bid price, and you have an offer price. The bid price, which is in blue, is used to buy the spread. The red price, which is under the bid, is used to sell the spread, okay? Now, if you believe that the market is going to go up, and this is where everybody gets confused, but let's say that you expect the euro dollar to go up, okay? The current price on the offer is $17.83. Would you want to buy the ceiling, or would you want to buy the floor that is closest to price? You want it to go up, you would want to buy the floor, okay? The ceiling is the limit on profits when you're buying a spread. Does everybody understand that? So if you buy $17.80, okay, that doesn't really make sense because that's the maximum spread. That's the ceiling. You can't go any higher than that to make profit. Do you understand that? So you're always going to buy the left-hand side of the spread, okay? And that is because if your floor is at 1.1780, okay, if this is your floor and you want it to go up, because your ceiling is going to limit your risk. Do y'all understand that? This is directional. Okay? Now, what is your risk if you're doing that? You're paying the offer price, okay? So your risk is the offer price that you entered on minus the floor, or in this case, it's $3. Does everybody see how you calculated that? Now, your profit potential will be the ceiling minus $17.83, which is what you paid on entry, or $97. Now, notice that I said potential profit, okay? How is it actually calculated? At expiration, let's say that the expiration price is at 1.1790, okay? You entered at 1.1783. So your profit would be $7, excluding exchange fees. Does everybody see that? Does everybody see how that is calculated? Now, what if you want to sell? Well, the first thing you need to think about when you're trying to sell is you're expecting the market to go down, okay? So what we like to do is sell when price is up at the top and then it goes down. That's the whole basis of selling an instrument, okay? Based on that, you would sell the ceiling. Do y'all understand that? The ceiling is up here. You expect price to go down to the floor, okay? Are the fees in spread the same as binaries? Yes, they are, Tom. Okay. So what's going to limit your risk? The ceiling limits your risk, and the floor limits your profit. Again, the red price is what you would sell, and if price is close to 1.1780, you would sell this ceiling, okay? Now, the price that you pay on entry in this example is $17.69. So when you subtract that from the ceiling, then your risk on it is $11. Does everybody see that? What would your profit potential be? It would be your entry price, which is $17.69, minus the floor, or $89. Now again, let's presume at expiration that the price was at 1.1760. What would your profit be? It would be the difference between these two numbers, which is $9. So the spread doesn't automatically have a fixed payout like a binary option. Instead, it varies according to how big the spread is. Now this, I believe, is a 2-hour binary option, so you can see they're about 100 pips there, okay? Each spread, whether it's a 2-hour spread or a daily spread, then they're going to have different amounts, okay? Any questions on that? Does everyone understand which is the floor and which is the ceiling? You know, the floors, to me, is a support area for price to go up. The ceiling would act as resistance, okay? Now, this is the big question that everyone has. When do you choose to trade a spread? Basically, when you expect a big move, okay? Market openings, market reports, if you're using leading indicators like the stochastics with hidden divergence. Also, when historically the data shows you that the average move for a specified period tends to be significant. Now, 3 questions that I ask myself are, what is the anticipated move? What is the risk? And historically, how much does this instrument move for this time period? These are all important questions and information that you need in order to trade the spreads. Here's an example. All right, it's the USDJPY 15-minute chart. Now you can see using the stochastics, there's hidden divergence because price is making lower highs, but the stochastics is making higher highs. That is the very definition of hidden divergence. You expect the market to come down. Okay, is there a spread available? Okay, in this case, there was a spread available that expires at 7 a.m. Now you can also see there is 1 hour and 2 minutes left until expiration, okay? Now, to sell this spread is going to be $3 of risk per contract or $30 for 10 contracts, okay? Your profit potential is $970. Wow, that's amazing, right? But that's trading 10 contracts, and again, if you were just trading one, it would be $97, right? But what is the next question that you want to ask? Okay, is it feasible for the USD JPY to move significantly in the next hour in 2 minutes? That's the question that I ask, okay? Because you want to trade a spread when you're going to have movement, okay? Well, in trading Nadex binary options using currencies, I provide you with the average movement for every month of the year per time, per hour, okay? So if I'm looking at 7 o'clock for the month of December, you're only going to get about a 21 pip move. That's the maximum, okay? So is this something I want to trade? Not really, okay? You're not expecting a big move. Do y'all understand that? Now compare that to, for example, January, because we're coming up in January from 8 to 9, it moves 34 pips. From 9 to 10, the average is 27. From 10 to 11 is 32. So the same thing for February, the same thing for March, okay? So I already know from looking at these charts that during this time period, I'm probably going to use a spread. Does everybody understand that? Why? Because that's when historically the bigger moves will come in during those particular months and those particular hours, okay? When, and you can look at this chart and say, okay, would you necessarily want to use a spread in September at 7 o'clock? Probably not, okay? What about October? Probably not, okay? Do I have these charts for all of the instruments? Richard, I do. Email me. Okay. This chart is actually in my latest book, Fletcher, Trading Nadex Binary Options Using Currencies. This chart, no, it's not available on Nadex, Ernest. It's data that I've gathered over the last 10 years. I actually have it from, I believe it's 2005. And it's printed in the book for each of the currencies. Any other questions on this chart? Wouldn't a hypothetical trade have a 7-to-1 risk to reward ratio, assuming a 21 pip move? Not necessarily, and I'll show you why. Let's go back to the chart, okay? All right, now this is your order ticket, okay? So in this case, the Nadex indicative index is at 44, correct? You're paying 37. Okay, so price will need to move down to 37 for you to break even. Okay? And then it would have to continue to move down for you to realize a profit. And then what if it doesn't? The big thing with a spread, Jim, is you want a movement. Today, what happens at 2 o'clock today? Well, 2 o'clock today, we have the FOMC releases, and it's 4 releases. Okay, that's going to be a big move. Okay, that's more interesting to me. What do we have tomorrow morning on the British pound and on the euro? Well, we have the rate announcements. Al, yes, I do. I have it. I have tables like this on the Dow, the NASDAQ, the ES, gold, and crude, I believe. I've been doing these tables for about 10 years now. Any other questions on that? Do you typically want to stay away from trading when there are announcements or be in the market? Tom, that's an excellent question, because I started out on forex, and then I traded forex and futures and commodities, and I always planned my trading around market reports because I never wanted to be in the market when there was a major market report. With Nadex, I'm a market report trader, okay? Give me a market report and I am all over it. Why? Because you can limit your risk in Nadex, okay? Now, you know, sometimes indicators are great. They work perfectly. Sometimes they don't, okay? And I am a firm believer, if you control the risk, then the profits will take care of themselves, okay? And Nadex gives you that opportunity, okay? You control the risk because you decide how much you're willing to risk on any particular trade. And you can't lose more than that. And the other thing, how many of you in the room have heard about Bitcoin? Well, Nadex is bringing Bitcoin spreads on Monday, December 18th. Okay, now I will not trade Bitcoin on anything but Nadex, okay? Why? Because the thing is crazy, okay? But I can limit my risk with Nadex. You can't do that anywhere else, okay? I can buy it, I can sell it. I can do anything I want with the spread on Bitcoin through Nadex. You can't do that anywhere else. Can I use the charts on Nadex for this? You can. The only thing is you're constantly going to have to be changing your charts. If, for example, you're doing a 2-hour expiration, okay, then you're constantly going to have to change your charts for the 2-hour, you know, expiration. And Henry, that's a really good question, because you know, I have something like this. Can y'all see my screen right now? It says watch list up at the top. Okay, so I can monitor 1, 2, 3, 4, 5, 6, 7, 8, 9 currencies, 3 different time frames in one window, okay? And these are 3 separate charts. I have a 15-minute, a 60-minute, and a 240-minute, okay? I can actually look at all 3 of these charts at one time with multi-charts or with NinjaTrader, okay? And I never have to change my chart, all right? Now, with Nadex, you can bring a chart up, but let's say the expiration is at 8 o'clock. All right, then you want to go in another 2-hour binary, you have to bring up a new chart. Do you understand, Henry? I don't like changing my charts like that. I just like to see one chart. This is it. This is what I'm trading. Okay. You're welcome. Any other questions about this one? Now, this was non-farm, and somebody asked me, do I trade market reports? Okay, this was non-farm employment day for me, okay? And notice how I combined some of the spreads So for example, on this one, I was long, but then I had a protection order for 5 shorts. Okay. And then I did a US CAD and it was short because that was my direction. Okay. But then I did a long binary for only $19 of risk. Okay. And then also on the USD Swiss franc, my bias was to the downside, but I also did a binary to the long side for 1875. That's what I call a protection order. In case it goes against me, I've got the binary to cover the spread. Does everybody understand that? And the ones that actually lost money that day were the protection orders. And you can see the protection orders were very low risk. And I do that on non-farm employment because it can do whatever it wants to do. So, you know, this protection order, less than 20 bucks. Okay. On gold, my bias on gold was to the upside, but I had a short as well. Okay. On the US CAD, my bias was to the downside, but I had a protection order in the market. On the USD Swiss franc, I had a short position, but then I had a long position as a protection order. Okay. And I mean, these are very powerful when you combine them with the binaries. It just gives you different ways to strategize your trade and say, okay, if it goes against me, I've got this one to cover it because we know it's going to move, and it did. Now, if you want to visit my website is TradersHelpDesk.com. You can also contact me via email at gm@TradersHelpDesk.com if you have any questions. Now, do y'all have any questions today? Yeah, you can trade spreads and have binaries as protection as long as you're expecting the market to move. And I know non-farm employment, the market moves. I mean, the USDJPY typical movement on non-farm employment change is 80 pips. The strike width on the binaries for the USDJPY earnest, 4 pips for a 2-hour binary. Okay, if you get an 80 pip move, that's a lot of strikes. I usually divide it by 2 and say, okay, there's 40 pips there for it to move, and I'll go out usually 3 to 4 strikes. Some of them you can't go out that much. Henry, when you're expecting a market to move significantly, okay? For example, this afternoon for the FOMC, the market is going to move significantly. You could actually utilize a spread for that, okay? When to choose a spread, okay? This one? Do you recommend trying to really understand one forex, such as US CAD, or trade all of them? You know, I think when you limit yourself to just the US CAD, you're limiting your potential to actually be in a trade because you're looking at one market. I look at 9 markets, and then I choose the best one or the best two for the day. What's your advice on concentrating on trading just one index or two at the most? Well, and this is a good example, Ernest. You know, if you limit yourself, for example, the Dow and the ES, okay? Well, there's been a lot of days that they don't move and the NASDAQ takes off. But then the Dow and the ES take off and the NASDAQ don't move. You know, so I look at all three of them and I try to choose the one that's going to move. You know, maybe a good analogy for you guys if you're new in the market. If you have a convenience store, okay, are you going to sell one kind of chocolate or are you going to sell multiple kinds of chocolates? It's the same concept. I run a trading store, okay? So I need to make sure I've got enough products here that gives me enough choices to make money in the markets today, okay? And if I'm limiting myself, okay, I'm just going to trade the USDJPY, okay? Well, I can do that, but I can't expect to trade on that every day, okay? Sometimes forex is moving, sometimes futures is moving, sometimes futures is moving and forex is not moving, okay? So I need an assortment in my basket to choose from. Because if I just have one piece of chocolate, it's just not going to last very long with me. I'm going to get bored with it, you know, jump in when I shouldn't be in the market. You know, if I've got a basket, I can actually say, okay, out of this basket, which one is the best setup for today? Okay. And that kind of calms me down too. And I've got, you know, I know some traders that are just absolutely married to the ES, you know, and I've never understood that other than, you know, you've got the liquidity in the ES, but most retail traders are not trading enough contracts to be concerned about liquidity. Okay. So why are you in the ES? It's the worst moving of the indices. And I've got, you know, years of research to show you. You know, the ES moves on average 15 to 20 points. The NASDAQ, on the other hand, moves 35 to 40 points. Which one do you think is going to be easier for you to make money on? One that doesn't move a lot versus one that does move a lot? And the Dow, at one time, the Dow was making was actually moving about 300 points. It's down to about 150 on average right now. But still, 150 is better than, you know, 15. It's 4 ticks and a point on the ES, so that's 60 ticks in a day versus 150 on the Dow. Now, if you're trading 100 to 200 contracts, you need liquidity. But most retail traders are not trading 100 to 200 contracts on the ES. But that's where they go because that's where everybody tells them to go. Okay? I'm going to trade what's moving because that's what makes me money. Any other questions? Didn't mean to start preaching. Do I ever put a spread on both sides of the indicative? No, I do not. I generally will use a spread binary combination versus, you know, having two sides of a spread. Because what if it don't move? Any other questions? Okay, if there's no other questions, I would like to thank you all for joining me. I really enjoyed you being in the room today. I hope you learned something, and I hope you have a wonderful trading week.